presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for March the 25th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, I want to remind all of you to click on the subscribe button so whenever I do an update, you will be notified and you can watch it at your convenience. Let's start with the numbers last week. We did see the S&P stabilize and close positive for the week. So that was a reversal week up. We went to below the last week's low, closed positive, which is a good sign for the market. But I like to see the NASDAQ leading to the upside. It was only up 0.18%. Then number two was the S&P up 0.53. Then the Dow up 0.21. I'd like to see it in reverse order. I'd like to see the NASDAQ going up the most, then the S&P, and then the Dow. So still a lot of uncertainty in the market right now about tariffs. We don't know if they're going to be all tariffs, all the countries are going to be tariffs on April 2nd. Then we heard yesterday that some countries might be excluded. There might be some sectors that might be excluded. But today we heard that the automobile sector and the tech sector will be included. So still a lot of uncertainty with these tariffs, how much they're going to be, how long they're going to last, which countries and what sectors are going to be tariffs, and what impact they're going to have. If we knew what it was, we could calculate it, figure out what sectors are good, what sectors are bad. But right now, no one knows exactly where these tariffs are going to end up. And that is by design. The president is staking out a position that he wants to negotiate with, but nobody knows exactly what that position is right now. Looking at energy, it was the best sector last week, up 3.2%. Utilities, materials down slightly, and we saw the S&P up about 0.5% for the week. For the year, energy is number one, healthcare is number two. Financials have also done well so far this year. Oil was down last week. It continues to move lower as there are talks going on in Saudi Arabia between Ukraine, United States, and Russia, where they're going to try and come up with an agreement. But I think my guess is it's going to be a while before we get to a ceasefire in Ukraine. Looking at treasuries, they did move lower last week, 4.31 to 4.25, slightly lower, but still in that nice range of 4 to 4.5%. As long as we stay there, that is what we call the Goldilocks situation. Again, people are worried about what's going to happen. You look at the risk assets, the Max 7 are year-to-date down about 12%. Risk assets, again, Bitcoin down 13%. Dollar index is down 4%. And you're looking at the S&P down about 3.5% overall. If you have a balanced portfolio 60-40, you're down 1 or 2% or somewhere around there, depending on where your portfolio composition is. But that does not, it's basically a pullback in the market still. It's a correction, and that's what 10% or more is a correction. We've got close to it. NASDAQ definitely in a correction mode, but we're not in a bear market. But the problem is, you look at the rest of the markets around the world, China is up 17.6. Europe is up 15.6. International is up 7.8. As you've come to a lot of these seminars and webinars that I've done over the years, the last 5, 6, 7, 8, 10 years, we've been looking at international markets. They've lagged the U.S. market dramatically for the last decade or so. And now they're all of a sudden, seems like U.S. exceptionalism is on the wane, and we're seeing some of these international markets, even though they have severe problems in Europe. They are starting to put more money into their defense. They're talking about cutting back on the safety nets, and they're starting to cut back on regulation. If that does happen, they have to go a long, long ways before they get there, but at least they're looking in that direction, and that could be positive for their markets and their economies in the long term, so we'll have to wait and see. Retail sales rose 0.2% month over month, still a very, very low number. It seems like retail sales and the consumer is losing confidence in the U.S. economy. And that could not be good news for the U.S. economy overall, as 2/3 of the U.S. economy is dependent on consumers. FOMC, they had the Fed meeting. One thing they did do, we talked about this a lot, quite a bit last week. Javed brought it up in the podcast. That's a much longer version of this YouTube update where we talk in a lot more detail. And one thing he said nobody expected them to change interest rates, which they didn't. But one thing Javed brought up last week was that he expected the Fed to cut back on QT, which is quantitative tightening. That means the bonds that are maturing, they're letting them run off. He said, well, they could say, well, if we are going to buy some of those bonds back, that means they're going to print money, buy bonds, and put that money into the system. And they did. They announced $20 billion more that they're going to put back or buy bonds, treasuries with it. And that is basically another way of loosening the economy. And that did help the market last week after the Fed announcement and on Friday. And yesterday, we did see the markets do very well. Today we get home sales slightly weaker than expected. Durable goods came out slightly. Initial claims. We get the GDP final report for the fourth quarter. We already know could be slightly. Not a lot of economic data this week coming out. Looking at the technicals, we did bounce back above the 200-day. This is the 200-day moving average right here. And we did close above that yesterday. Finally, we got above it. And that's a good sign overall that we're starting to see, and we are above it today. So as long as we can stay above the 200-day, which is a good sign, next resistance is going to be 59.12, which is quite a bit. We're at 57.66, but that was a good close overall, and we are starting to see. Now, is this a fourth wave? This is two, this is three, and are we seeing the fourth wave, and we are going to come back for the fifth wave to the downside? We'll have to wait and see. There's a big gap right here between Friday's open and Thursday's close. As long as this gap remains open for the time being, that could be a positive sign technically. So this week and next week are going to be critical if we're going to get the follow through. Another interesting thing happened on the weekly charts. Each one of these lines, vertical lines, is 1 week of trading. This you can see we went below the 50-week moving average, and that was October of 2023. And if you recall, that was a major bottom in the market right around 4,000 or 4,100. From there we took off, and as you can see, we stayed above the 20-day moving average, stayed above the 20-day moving average, stayed above the 20-day, but finally we broke it about 4 weeks ago. And then we came back down to the 50-week moving average, got below it like we did here in October of 23. And then the following week, we came right back up and closed above it. Well, the same thing happened last week. This number was, the blue line is the 50-week moving average. Last week, you can see this green circle right here, and we closed above it at 56.65 was the number. We closed at 56.66, just 1 point above this 50-week moving average. Today, we're at 57.66, so we are about 100 points above that number. So that is a good sign now. We might have completed a weekly fourth wave here, and now we're starting on the fifth wave, which projects up to somewhere around 62 to 6,300 from here. But we'll have to, again, seems like we've done this about a year and a half ago when we made a bottom. Similar tech situation here. Technicals, are we going to see some follow through in this? We'll have to wait and see. In my opinion, seems like we have made a short-term bottom, but as long as we stay above 56.80 or so in the weekly close on Friday on the S&P, we're okay. But if we close below it, that could mean we could be headed lower again. NASDAQ also had a good week, moved back up on Friday, big gap up. You can see this gap right here, and we're at 18,147 is the 20-day moving average, moving towards the 18,451. We need to get above that. That's the 200-day moving average. We're at 18,232 today. So if we can get above 18,500, that would be a good sign for the NASDAQ. Weekly charts, as I said, my dot plot is still negative, where these dots are above the market. When that happens, usually it lasts 6 to 8 weeks. We're about we're in the fourth week right now of this, so we could get a couple of more, but we're right at the 50-week moving average, which is 18,164. We're at 18,232 today, which is a good sign as long as we can close above it. that would be a positive indicator. And then we'll have to wait and see if it can get above 18.7. Again, these dot plots are lagging indicators. They lag the market, but when they turn negative, usually we get some negative movement like we did here last October. And when we got here, this was beginning of 22. You can see that it was negative all the way down. Same thing happened in October of 23, and we stayed negative until about, or all the way down into October of 22, and then in 23 we turned positive. So we'll have to wait and see. I'm still sort of waiting and watching. The markets are healing, but we need some more follow through on the upside from a technical perspective. Looking at this, there's a big gap down here in interest rates. We came and tried and fill that gap. We're just headed, still between 4.5, and this is 4.43, which is the 50-day moving average on the yield on the 10-year, and 4.22, which is the 200-day. As long as we're in between there, which we are, 4.3 today, so we're okay on that. Small caps still bounced off the 200-week moving average 2 weeks ago, come back up a little, but I'm still not very excited about that. Gold seems like it's put in a fifth wave top, trying to pull back now a little bit. 2950 is support, and then 2900. We are trading at about 3030 this morning. Those are my thoughts. Those are my observations. Again, if you want a much more detailed analysis, Javed and I will do a podcast. Make sure you go to Market Wrap with Mo. Just on your app phone, type in one word, Market Wrap, W-R-A-P, with Mo, and that'll bring you the app. It's a free app. Download that on your iPhone. When we do a podcast, it's a much longer version of this where we talk about these markets in detail. If you want to subscribe to this, go to compact.com/YouTube, click on the subscribe button. And also, if you need help with your portfolio, give us a call. You can send us an email at invest@compact.com or just call us at 800-388-9700, 800-388-9700. You can send us an email or give us a call, and we'll be more than happy to help bring you up to date, what we're doing, why we're doing, sit down with you, develop a plan for you. All of that is free. Have a wonderful week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.